world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here.
Hello and welcome to Rebank. I'm your host, Will Beeson. Donna Parisi is a partner and global head of financial services and fintech for Shearman & Sterling, a leading global law firm. In addition to her work on a range of derivatives, structured products, securitization, capital markets, and commodities matters, Donna has built specific expertise in crypto, tokens, and digital assets, which are the subject of our conversation today. Donna and I discuss regulatory frameworks and institutional infrastructure for digital assets, where the space is going, and why. You'll note that we intentionally don't dig into Facebook's Libra project, which I may pick up in a standalone episode in the future. In addition to the insights we deliver through our podcast and newsletter, Rebank offers advisory services to fintechs, banks, and corporates. Drawing on our experience starting, running, and advising fintech businesses, and our vast network of the most impactful fintech entrepreneurs, investors, and innovators around the world, we help companies make sense of fintech, work through specific questions, and optimize proposition and strategy. For more information about our services, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Donna Parisi. Donna Parisi, welcome to Rebank.
Thank you for having me, Will.
Can you introduce yourself quickly and set the context?
I'm a partner at the law firm of Shearman & Sterling. We're a global law firm with offices in 18 countries, and I'm head of financial services and fintech at the firm.
So what does that mean in practical terms, financial services and fintech? That's everything from, traditional advising on M&A transactions at big banks to derivatives and securities and more edgy fintech stuff.
Yeah, it runs the gamut, right? So financial institutions are our largest client segment. So whatever they're interested in, we need to be interested in order to remain relevant to them. And so that was our entree into fintech several years ago. It became clear that fintech was going to be a disruptor to the existing financial services model. So Shearman needed to jump into that fray.
So we could probably do a whole nother episode on the various fintech work that you guys are doing, but I understand that you're an expert in digital assets and crypto law / regulation, which I thought would be a fun thing to pick. Well, maybe not fun, but an interesting thing to pick up today. Is that a fair characterization? Have you spent time looking at that space?
Yes, I have spent some time in that space, and I guess I would say that I'm as expert as anyone can be in a very emerging and rapidly evolving landscape.
Yeah. So maybe to start, you can describe for us what in your mind kind of the taxonomy of the space looks like. So you have digital assets, you have cryptocurrency, you have, I suppose, blockchain, more the infrastructure underlying both. Crypto has kind of grown out of this fringe, counter-capitalistic mindset, and it's in some ways attempted to be rolled back into the kind of mainstream paradigm. Digital assets, maybe a broader term. How do you think about things?
Well, I think it's interesting because oftentimes we use those phrases interchangeably when they're not quite interchangeable. So you sort of refer to what I would call the crypto anarchists, right? And so you have digital assets like Bitcoin coming from an environment where there was a lack of trust in the system, a lack of trust in a centralized intermediary, and people wanted to be able to exchange and store value outside of our traditional governmental and sovereign structures. Right? And then it's evolved and morphed from there. And there still is a segment of the population that look at crypto as a way to be outside of the traditional financial service system. And I think, one of the things when we're talking with regulators and that I encourage them to do is to think about why, right? There is a legitimate problem there that people are trying to solve through a crypto asset. Digital assets are more broad, right? So a digital asset can be a store of value. It can be a cryptocurrency, but it can also be what we would call a security token, something that's just a digital representation of some sort of asset or right. And then blockchain and distributed ledger technology are sort of the technology that powers that ecosystem.
And how would you describe the clients that you work with in this space? So the business conversation that you're having, is it does it cover what you kind of characterize as the crypto space? Is it more digital assets focused? Is it more infrastructure focused?
Well, it's all of the above, right? So our clients range from startup entrepreneurs using the blockchain to solve all sorts of problems. I have some what I would call digital asset boutique investment banks or merchant trading folks that really focus on crypto assets and powering that ecosystem through private equity investment, but also through trading. We have our traditional financial services clients who are involved and getting more and more involved in this space. And then we have actually our corporate enterprise clients that are using this technology for things such as supply chain, authentication of goods, transfer of IP rights, things like that.
So if we maybe address those two categories of users, the crypto piece first, and then the broader kind of more institutional digital assets people second. So from a crypto standpoint, what sorts of conversations are you having with clients or potential clients? What are they asking you about? What do they want to know right now?
So one thing that we need to address head on, if I'm looking at someone who potentially wants to issue a crypto asset or trade a crypto asset, is that what is that under a U.S. regulatory scheme? Is it a security? Is it a commodity? Is it something else? And what laws and rules and regulations do they have to comply with? So in the U.S., that we have many agencies that govern crypto and digital assets, but the two main ones are the SEC and the CFTC. And if something is a security, the SEC, the Securities Exchange Commission, is going to have jurisdiction over it. If something is not a security, but pretty much anything else other than onions or movie box office receipts, which is just a quirk of history, then it's a commodity.
Wait, literally.
Literally.
Okay.
Yeah. If you look at the Commodity Exchange Act of 1972, you will see that a commodity is anything, a big, long legalistic definition, but it's been, any right, interest, so on and so forth. It picks up everything. There is an exclusion if something is a security, right? That's the SEC's turf. Everything else is the CFTC's turf, but you carve out onions and movie box office receipts.
I feel like there's an arbitrage opportunity somewhere in there.
And so we try to figure out what is it, who has jurisdiction over it. And what's really interesting is that if we look at the statements of the SEC and the CFTC, it seems very clear that what a particular digital asset is at any point in time can change. So you can start out with something that may very well be a security. And one of the tests that we look at is there a third party that is sort of controlling and sponsoring that digital asset? But if you look at something like Bitcoin or Ethereum, right, the theory was maybe in the beginning there was actually this sponsor, but over time, as more and more users came and the governance structure became more decentralized, then you're no longer a security and you would be a commodity.
Right, because I guess maybe simplistically coming into this, I was thinking that okay, so ICO is kind of equals security, and that's like, it seems like what some of the SEC guidance has suggested. But if you're talking about something like Bitcoin, which is effectively mined, right? Like it's never issued, it's never marketed, it's never sold. It's kind of created through quote unquote work of individuals in the platform. So is that generally thought of as a commodity?
Well, Bitcoin, the CFTC and SEC have made statements that make it clear that Bitcoin will be treated as a commodity for these purposes and not a security. And it's not so much, in some ways, the issuance, it's what are the investors' intent and how is it being sold or marketed? Why are people investing in the asset? And if it's for investment purposes, for capital appreciation, for gain, then you're very likely to be a security. And again, also, if you have someone that's sponsoring the asset, you're very likely to be a security. So I think the rule of thumb right now in the U.S. is that it's very hard to make a distinction between a pure utility token, where you're issuing something that's of value in a particular closed system, versus a security token. And so for the most part, you're going to be in security token land, which may not be such a bad thing, except that it currently, we're going to need some regulatory no action relief or other guidance and expansion of some of the existing rules and regulations to allow digital assets to be issued as securities and comply with all the related rules and regulations.
Because fundamentally, the concern, if you're a crypto entrepreneur, is that you issue a token and you end up kind of retrospectively falling afoul of SEC rulings, right? And then you're in all sorts of trouble. That's, I guess, if you first ignore the 99% of kind of leading edge Wild West crypto types who were looking to kind of race to ICO to capital raise before there was regulatory certainty and kind of take their chances. In retrospect, that seems like it was a bad idea. Do you expect penal action or punitive action to come upon those who maybe were issuing what clearly look like securities but without the proper
Yeah, I would
framework
say
around it?
even a year and a half ago, I would be talking with clients and potential clients, and they were quite certain what they were doing was not issuing a security. And I had my doubts
You
at
were
the
certain
time.
that it was?
Yes.
Okay.
But I have to say the SEC's pronouncement now has really penetrated the market. And I think most people and most clients and potential clients I talk to understand that if they are issuing some sort of digital asset, they need to think hard about the security analysis, and more likely than not, it's going to be a security.
Which, again, as you're saying before, means there are potentially costly legal and compliance requirements, but there's a clear framework because companies have been issuing securities in the 1933 Act, which kind of governs a lot of this. So, going on 100 years now, like, it's very clear framework. It's just a question of complying with it. Or is there still uncertainty?
I think that there is still some level of uncertainty as we work through it. And you and I have had this conversation before. I actually think that the beauty of the U.S. regulatory system is its elasticity, right? So the test that we go back to when trying to decide whether a particular asset is a security or not is something called the Howey test. It was decided back in the 1940s, and it had to do with growing oranges in an orange grove and whether or not someone that was purchasing into that business was purchasing an investment contract or not. So in the intervening 70 or so years, that Howey test has withstood the test of time, and it's been applied to a lot of different situations. And now we're going to take a digital asset or a crypto asset, still use that Howey test. But the principles are broad enough and elastic enough that we don't have to throw out everything that's come before. We can just try to fit it into this new framework, but that framework's going to have to stretch. And I do think that the SEC is going to have to issue some additional guidance. They issued some guidance recently within the last 2 weeks. Some of the criteria that were included in that guidance, I think, aren't necessarily practicable or true in a lot of the cases. So it's still an evolving landscape. But we'll see, and we certainly have more certainty that something is a security or not than we had even, say, 2 years ago.
Yeah. Is the lack of guidance from the SEC still a meaningful constraint around what entrepreneurs in this space can do? Like, are there projects that people come to you with and you say, look, I wouldn't progress this because we just don't have certainty as to what the treatment would be and what we should do.
I mean, the other thing to note is that this whole idea of an ICO is really, how do we fund a project, right? How do we capital raise? How do we fund a project? And so maybe the ICO route now isn't the easiest or best way to go, but that doesn't mean that there's not lots of alternative sources of funding and capital that are available to digital assets and crypto assets generally. So I think the landscape has shifted. I think that you're not going to see a lot of ICOs, especially in the very much startup entrepreneurial phase, for the regulatory constraints and costs that go hand in hand with that. But we certainly haven't seen any diminished interest in digital assets. So I think that you're just going to look to fund those ventures in different ways.
Do you view tokens and ICOs as kind of a meaningful and potentially permanent source of funding for the broader startup or growth stage ecosystem, or was this kind of a regulatory gap that people were taking advantage of for a short period of time that will kind of go away and be replaced by more mature mechanisms?
Yeah, again, fundamentally, you were looking at, when you say a token, you're looking at a digital representation of something, and I think the consensus has now coalesced that what that something was a security or an investment contract, right? So in some ways, calling something an ICO or a token isn't that different from a paper stock certificate or a dematerialized notation on a ledger. So I think that there's some confusion. It's not really the form, it's the function and the purpose of it. So again, I think that we'll see ICOs perhaps being a much less popular form of capital raising and funding, but you'll see other ways of achieving those same goals.
What's your sense of how developed or advanced the U.S. Framework is at the moment compared to other jurisdictions?
I definitely think that the U.S. is lagging behind, say, the U.K. and some others. But I also think that you need to look at where the U.S. sits in terms of the development of its market, its capital markets in particular, right? So there is a lot of confidence in the U.S. capital markets. In fact, companies from all over the world come to the U.S. for financing. And so U.S. regulators are going to be less motivated to take risks and jeopardize the confidence in the system. Whereas you look at some more emerging jurisdictions that are trying to claim a place, I'm thinking of like maybe a Malta or a Gibraltar, or you look to Southeast Asia or Africa, and you're looking at geographies and governments that don't have a really strong functioning financial services industry, and they're trying to provide fundamental core banking services to their people. They're going to be less risk averse because when they're doing the balance, what's more important to them is to serve their constituencies, the underbanked and the non-banked. And where in the U.S., we're going to be more conservative because we've got something to protect that's very valuable, which is confidence in the system.
Is jurisdiction selection a criterion for entrepreneurs in this space, or is it pretty much, one axis, the U.S. market is this where my product is, and it's a massive market, and that's where the funding is going to come from?
I think it sort of depends on what your use case is and what your business model is. We see startups and entrepreneurs all over the globe, right? In payments, in digital assets, in crypto. It just really depends on who they're trying to serve. But yes, at the end of the day, if you really want to scale up and access capital, at some point you may very well decide that you need to come to the U.S.
Is that similar? Would you have a similar answer from kind of an onshore versus offshore standpoint? You have all sorts of bizarre crypto exchanges or whatever based offshore doing potentially nefarious, unregulated things. I mean, is that a viable route for someone who's interested in raising capital through a token sale?
I mean, I think that while the details may differ, I don't think that there's any sovereign or regulatory system that wants to permit fraud and manipulation, right? So, again, exactly how that enforcement mechanism works is going to vary by jurisdiction, but I don't think that there's any tolerance for fraud or market manipulation anywhere in the world.
So potentially linking this to the other side of the taxonomy, the digital assets piece, So I think there's some core pieces of infrastructure that are currently lacking to support, this broader token economy, specifically exchange, i.e. secondary markets, robust secondary markets that institutional players can trust, and also custody. Are you finding that those are areas of interest from clients or potential hurdles that are preventing institutional players from getting involved in the
Yeah,
in the space?
Absolutely. So one of the use cases that we hear a lot about from our clients is the tokenization and fractionalization of a variety of assets. And I'm thinking illiquid assets like real estate, like art, like metals coming out of the ground. And so there's a tremendous amount of interest in tokenizing them, which is essentially just making a digital representation, right, using blockchain or otherwise, and then fractionalizing them so that more people can participate, for example, in a piece of art, an artwork that might not be accessible to many in the retail space. So that's a really powerful use case. What that leads to is a liquid market and secondary trading in the asset. And again, we have a whole host of regulatory requirements that go along with that. But I think that that's something very exciting.
Yeah, because basically it's no different than shares in a company are originally like slips of paper that said, you own X percent, or, one of 100 million shares, or how many outstanding shares the company has. The more shares you own, the more of the company you own, and those are easily exchangeable because you can sell someone else the share certificate and pass it back and forth. And eventually those were made electronic, and from a tokenization of art standpoint, it's fundamentally the same concept. It's now, there's software that can easily manage this. Through cryptography, the ability to have unique digital assets, i.e. not the infinitely replicable MP3 from the kind of Napster era file sharing, but crypto-enabled, this is my fraction of the piece of art digitally, this is your fraction of the piece of art digitally. I guess to your point from before, the existing framework and the flexibility of the existing framework, these are concepts that we're familiar with. The terminology can be a bit confusing, but fundamentally a lot of this stuff, especially when you're talking about tokenization of physical assets, is not new. Is that fair?
I think that's fair. It's just that I think we're looking at a technology and an infrastructure that can make that much more efficient, much more real time, and provide a lot of information to a lot of people, which will promote their liquidity and participation by a wider segment of the population.
So, based on the conversations that you're having right now, the level of activity with individual clients, I mean, what parts of this value chain do you see as most active and most rapidly evolving at the moment?
Well, I would say in the financial services space, you're looking at clearing and settlement. Right? We have very robust clearing and settlement mechanisms, and they've been working, and they don't fail very frequently, if at all. And so what we're seeing is that you've got the legacy players that have robust systems, but that are perhaps slower and not as efficient as they could be if they were built with today's technologies. And then you have challenger banks and other service providers that are using blockchain to do the same processes, but they're able to scale up quicker and customize more. And so we'll see, I think, how that plays out in terms of how robust those systems are. I guess I would say, mention a few things from a legal perspective, which I think people don't necessarily appreciate, which is from a legal perspective, when we're talking about blockchain, we can have truly public systems, right, which is what the crypto anarchists are all about, right? They want truly public distributed ledger that is proved by consensus. Then you can have private or permissioned blockchains. And from a legal perspective, it's much easier to deal with private permission blockchains because we can use contracts to set the rules of the road, have people agree to them. We can perhaps pick our jurisdictions that we want to apply in certain circumstances. I think the legal system still has a ways to go to understand how to really implement a truly public blockchain. So clearing and settlement is a closed system. So I think you'll see a lot of activity there. When you're talking about a truly public blockchain-based system like a Bitcoin, that's going to be very interesting to see how the legal landscape evolves.
You said something interesting to me the other day, which I had not considered at all, which was around the nuances of accounting for some of these assets and the importance of doing so.
For example, I've been working on derivatives documentation for trading of crypto assets, which is interesting because you mentioned earlier this idea of how long will it take for this space to become institutionalized. And one of the challenges is that we need to have robust rules of the road and documentation so that if we're doing a Bitcoin option or a Bitcoin swap, we know what's supposed to happen. And what's supposed to happen in other established asset classes is very clear, and we hardly give it a second thought, right? But some of the issues that we have to deal with crypto assets are, what's your price source? Where are you getting your valuation? What happens if that price source goes away? What are our fallbacks? What happens if I have a dispute as to how you're calculating something? How should we handle an airdrop? How should we handle a fork, right? If you analogize to the equity markets, because they're so liquid and transparent, whatever the price impact of a certain event is pretty much immediately reflected in the price. Whereas the kind of conversations we're having in the crypto asset world is, well, how long do we wait to see if a fork is going to be supported? Or if an airdrop actually has any significant economic consequences such that we're going to have to adjust the terms of the contract. We have all sorts of delivery issues, right? How is something delivered and held? One of the barriers to institutionalization of the crypto market is the custody solution, right? How do we keep things in custody in a way that they're protected, such that the regulators have confidence, such that they're auditable, such that they can actually still be transferred efficiently, which is why we probably started down this journey to begin with. You've got some players in there. Fidelity just announced their custody solution. BitGo got a big investment from Goldman Sachs. I know the SEC is very focused. The CFTC is very focused on custody. So, more to come there. But that if we can overcome the custody challenge, I think you'll see an acceleration in the market.
What would it take to overcome the custody challenge? Is it just people investing in the infrastructure?
I think people have to invest in the infrastructure. It has to be made robust, and there has to be an auditability function, right? So that the regulators can have confidence that the assets are where they are and they're safe and secure.
You mentioned some of the outstanding questions around, for instance, accounting for secondary market transactions. Are those things that in your mind and kind of in the minds of the broader community have obvious answers, or are they, genuinely, open-ended, unanswerable questions that are going to take years to resolve?
I don't think it's going to take years to resolve, but I think there's a lot of gray area and a lot of questions. For example, in the tax space, right? To date, crypto assets have been treated as property. What does that mean, right? How do we treat them from a tax perspective? And I had a very interesting discussion with a colleague over dinner the other week where, my tax colleague was sitting around and trying to answer some of these tough questions in the tax space. And they're trying to analogize. And one of the analogies they made is it like a calf, right? If you have a piece of property like a cow, and the cow has a calf, is that what a fork is, an airdrop is, or not? Is it something else? So I don't think it's going to take... I think the journey will be years. I don't think it's going to take years to answer some of these questions. I think that the regulators have heard loud and clear that they can't stifle innovation. They just need to find that sweet spot between responsible growth and innovation and protecting the system.
Is your gut feeling that we're at kind of the early stages of a significant industry transformation around digital assets, and that this is where investments is going, this is where potentially banking and payments is going, this is where potentially lending and insurance are going, or is this more of a niche development?
I think we are still in early days, although we've come a long way over the last several years. I think that blockchain and crypto by itself are really just technology and are not as transformational as when you couple them with other areas of fintech, like AI, for example. So if you start harnessing the power of these different newer technologies and putting them together, I think you'll see a different way of doing business going forward.
Are there any specific tangible ideas or thoughts that you may have around what some interesting future use cases building off of the component building blocks look like?
Yeah, and I'm not going to say anything that's surprising to those of you in your audience. One of the ones that I think is very interesting is digital identity. Right. So for those of us in the United States, in the United Kingdom, in developed markets, we worry more about having government control or private company control over our identities and what they're going to be used for. But if you look globally, there are hundreds of millions of people that can't prove that they exist. They don't have an identity. And if we can use digital identity to establish things like a credit history, a credit score, prevent human trafficking, I mean, that's really an incredible change. So that's one use case. Again, I think I sort of mentioned the authentication, right? So in terms of counterfeiting of goods and services, using the technology blockchain to authenticate items. One use case that's very interesting to all of our corporate clients is supply chain, right? So embedding the information of where the constituents of their products come from, where they are logistically at any point in the world. You marry that up with the Internet of Things. And there's some very interesting work out there, for example, on Cardano, where they're trying to create some sort of cryptocurrency or digital asset that will be highly scalable, be able to handle a lot of transactions per second and micropayment transactions. So again, if you sort of take the micropayment, the logistics, the supply chain, that's an interesting use case. And then we've talked about tokenization of a whole bunch of illiquid assets and the fractionalization to promote trading.
So that, I guess, most simplistically creates new investment asset classes. If you have tens of millions and you want to buy like a Rembrandt or something, you can do that. But if you don't, then you don't really buy art as an investment asset. But maybe you can quickly, with a single click, buy a perfectly fractionalized portfolio that has one slice, $15 worth of exposure to a master's painting or something, plus fine wine, plus uranium, plus private equity, plus everything else.
Mm-hmm.
Is that kind of the concept?
Yes. And so I guess then you have to sort of ask, what's the motivation? Are you purchasing that because you want to own one millionth of a master's Rembrandt? Or are you purchasing that because you want to participate in any price appreciation?
Presumably it's the latter,
right.
And then it's a security. So who issues it?
Yeah, it's a security. And so you're gonna, in a system like that, you can have someone that's running the secondary trading system. They're going to be what's known as an ATS, an alternative trading system. But then also, I think from a more systemic view, you have to look at, do you think we're going to have bubbles in now all sorts of different asset classes, right? We look around, we had bubbles in mortgage markets, we've had bubbles in stocks, we've had bubbles in pretty much everything, tulips, right? Going back how many years? So I think one thing to keep your eye out for is to see whether or not by opening up the trading in the secondary market of some of these assets, do we need to be very careful about price bubbles?
Maybe there are traditional analogies already, but pulling these pieces together around the kind of legal and reporting requirements around securities issuance, potential securities law applying to fractionalized assets, how would the structure work if someone were to tokenize a piece of artwork? A company would purchase the piece of artwork and would be, effectively the one responsible for issuing the securities and maintaining the kind of regulatory filings and paperwork associated with that?
Yeah. I mean, again, depending on how you structure it legally, you're going to have some sort of corporate entity.
It's like a REIT or something, except it would own
right.
art
Or a securitization vehicle,
Mm.
right? If you look at an analogy to the securitization market.
What else?
You spent some time talking about the SEC, but some interesting thoughts that have come out of the CFTC that might be interesting is that for the first time, we've had some statements that indicate that if you're a developer and you're developing a blockchain or other system that is not compliant with the rules and regulations of the CFTC, but you are in a system that is not a permission blockchain, so you don't have someone who's in control or a sponsor, the CFTC has indicated that they may very well hold software developers responsible for producing a product that's not in compliance with CFTC rules. And again, that's not been an enforcement action. It hasn't been anything concrete other than some statements in some guidance and in some, other enforcement actions. But I think that that's really fascinating. And if you look at the recent case regarding spoofing, right, putting in orders that you have no intention of following through on, they did charge a software developer in that case.
Who built the systems, who wasn't actually the one inputting the orders.
Yeah. So I think that's interesting, right? And it sort of goes, as we shift to this more decentralized world, whose responsibility is it to make sure that we're playing within the rules and we're being ethical and we're not encouraging fraud and manipulation?
Are there precedents in other more traditional sectors or aspects of the law for something like that? I mean, I don't know. I guess if you started building cars that didn't kind of meet the regulatory requirements and selling those, then you'd presumably be held accountable. I don't know. Does that conceptually, from the legal standpoint, seem appropriate that software developers are potentially held accountable, or is that new ground?
I think it's relatively new ground. I mean, I think if we put our heads together, we can come up with some analogies, and maybe it's not the wrong answer. But I think that for the most part, when people are developing software, certainly in the B2B context, right? They think that they're meeting their customers' needs. They're going to come up with a product that suits it. They'll sell it to their ultimate corporate customer, and it's not their problem anymore. And I think that we need to be careful and perhaps rethink that a bit.
You mentioned AI before, and no discussion of crypto and digital assets and blockchain in this entire space would be complete without a mention of smart contracts. So what do your colleagues and the broader legal profession think about the convergence of machine-readable contracts, smart contracts, plus AI? Is this the end to the legal profession?
It's not putting lawyers out of business.
Is it doing all of your paperwork for you and allowing you to focus on other things?
So, I mean, really what a smart contract is, despite having contract in the name, it's just an embedded if-then statement. So if something happens, then something else will automatically happen. It doesn't actually go to the formation of whether or not you have a binding legal contract. There will be disputes that occur within the smart contract realm. It has to be very objective for a smart contract to work. And smart contracts are not infinitely flexible. One area that I like to raise when we talk about smart contracts is we're looking at a transition away from LIBOR right now. And we're looking at millions of contracts that need to be transitioned from an existing LIBOR interest rate to something else. And so my question to some developers were, if that happened today and we had all these contracts in smart contracts, the fact that we now have to transition away from LIBOR and use something else, would that be able to happen in the smart contract paradigm automatically? And the answer was, no, not unless we set it up that way to begin with. So smart contracts will definitely have a role and a place, for example, in derivatives trading. When you have the occurrence of something, a credit derivative, a particular exchange rate, and then settlement and delivery can follow from that. But they are of limited utility. And you have this whole legal overstructure, so you're not putting lawyers out of business anytime soon.
Shucks. Just kidding. All right, so where can people find out more about Shearman's fintech practice and connect with you guys for advisory work?
Yeah. You can look us up on our webpage at shearman.com. If you click on industries and fintech, you'll get more information about the Fintech Foundry. And you can also email us directly at shearmanfintech@shearman.com.
So you clearly are U.S. based, and a lot of this conversation was based around the U.S. frameworks. But in terms of Shearman's fintech practices, what markets are you looking at?
We have offices in 18 countries, so we can provide advice in a variety of jurisdictions around the world. We're a global firm.
Excellent. Donna Parisi, thank you very much for joining us today.
Thank you, Will.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.